Hey, everybody, happy Tuesday and welcome to it's officially National Nashville Predators Day today in Nashville. I'm joined today for Tax Tuesday by my good friend and tax confidant, Ryan Bakke. Got it right, right? So I
Yes.
used to call him Ryan back, but he corrected me last time. So now we are simulcasting this just about everywhere on every social channel that Build Short-Term Rental Wealth has. But I've got my full Nashville gear here. You can see Preds. Ryan, I'm sorry that we unleashed on you. Saturday night was a bad night for Blackhawks fans.
It was a whooping.
It was like the first whooping we've given anybody this season. And we love giving the Hawks some whoopings. So, were you at the game by chance?
No, I wasn't. But I get the alerts on my phone, so every time they scored a goal, it's just like bing, 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 and it happens. It was
It's been a
6-1
long
final,
time
right?
for us. We haven't been very good since we swept you guys in the first round in 2017.
Right. Yeah.
All right, let's talk about some tax stuff today. For those of you that are here, if you have any questions, just drop a comment down below. This is all about you. We're on the clock. This is like pardon the interruption style. We're going to jump right into it. We got 30 minutes. We're not here for an hour. It's not 2 hours, 30 minutes to answer every single question that you guys have for Ryan. So Ryan is in my opinion, the foremost tax expert for short-term rentals in the country. That's why he's here pretty much about every Tuesday to answer your guys' questions. And now, in my opinion, it's a very important time as you get ready to start preparing next month. Look, I know a lot of you are going to wait till like April 7th, April 10th to start working on your taxes. But if you did a cost segregation, if you're taking advantage of Section 179, if you have multiple properties, multiple entities, you might want to get a head start and start getting your shit prepared now and working on your returns that you should get from your CPA in early February and get ahead of the game. Would you agree with that, Ryan?
Yeah, but better now than late, especially the longer you wait, the more you're going to feel rushed to get everything in, and the more likely you are to miss something. And the more time you have, the quicker you get it done, the more better of the outcome for all parties involved.
So what do you see with, before we jump into the questions, I think it's an absolutely critical time right now for us as business owners, and every one of you that's watching that owns a property, you are a business owner. If you're co-hosting, you're a business owner. If you're doing arbitrage, you're a business owner. If you're a property manager, you're a business owner. And I think that right now is the time, because I think Ryan just said something. When we get under the gun, we get nervous, it gets down to the wire, we might forget something. Well, I'm pretty astute with my back office, but there's always things that I even forget, even though I try to like reconcile everything on a monthly basis. So start working on it now. Ryan, what are 3 things or just a handful of things that you see that traditionally people miss? Because I know you've done a lot of audits or reviews of previous tax returns for short-term rental investors, and you see a lot of things that maybe a regular CPA doesn't catch.
Yeah, I think for that first year of investors, it's that interplay between personal and business expenses. So a lot of times when people buy their first property, they're actually using their personal credit card or personal bank account. We need to keep that separate. We need to have a separate bank account, separate credit card for the rental property, as opposed to paying for stuff out of our personal account. That's how expenses get missed. If you have expenses in multiple accounts, not under the one account that's supposed to be for your rental property, that's how things get missed. And it's all about starting from square one and organizing it. And you have to know your numbers as an investor, because how can you actually tell if your rental is profitable or not if you don't have a cash flow statement that's prepared on a monthly or quarterly basis? And because I'll ask investors sometimes, hey, what's your cash flow for the year? And then they pause. How do you not know your cash flow, right? How do you not know what you're making on a month-to-month basis for that property? And that's the biggest.
Do me a favor, describe what that means, because I think there's a lot of people that don't know the difference between revenue, gross profit, and EBITDA, or let's just say net income, right? Cash flow.
Yeah. They're all very good metrics to analyze numbers off. Gross revenue is a great one, a really quick number, but really net income is what we're all striving for, because that's how much cash is going to hit our bank account at the end of the day after all that's said and done. And net income is typically gross revenue minus all your operating expenses. Now that'd be net income or cash flow. Now, taxable income is a different number, because for tax purposes, we're not allowed to deduct mortgage principal payments. So the equity that we have built up in the properties is not a deductible expense. The IRS really sees that as not a change of wealth occurred, so you don't get to deduct the mortgage principal payment. But yeah, so you got gross revenue, you got net income, net income or cash flow, and then you have actual taxable income. They're 3 different numbers.
Awesome. Hey, Ray Pace, thanks for joining us on YouTube today. I've got a couple of questions for you, but before we start with the questions, I'm a believer that since I have multiple properties, one bank account, one debit card, one credit card per property. Let's say for somebody that has 3 properties, and they're all in the same LLC, are you fine with them having one bank account for all 3 properties and using one credit card for all 3 properties, as long as they're diligent and they can break out the expenses per property? Or are you kind of falling into the realm of myself, one property, one LLC, one bank account, one credit card?
Yeah, people will want to put them all under one because they think that's easier. But yeah, if they're all the expenses are lumped into one, it's very hard to pick and choose which expense was for which property. So, and when you actually file the tax return, each rental property gets listed out separately. So each rental property, in essence, has its own separate books and records. So really, in QuickBooks or Stessa, there's an easy way to kind of go in there and tag a certain expense for a rental property. So you could have one bank account for 3 properties. You could have one credit card for 3 properties, as long as you're going in there and tagging each relative expense.
So, and you mentioned something about, and it's really the setup of setting up those tags inside of QuickBooks.
Yeah.
Peachtree, whatever you guys are using. I think most of you are probably going to be using QuickBooks or Stessa. But those categories, those tags are like the most critical component. I see most business owners inside of STR out that they miss. Would you agree with that?
Yep.
How granular do you recommend they get?
Pretty deep. I would say pretty detailed. If there's a shared expense, like let's say you have an expense that's across all the properties, you can almost just allocate it out. So let's say the 3 properties, the shared expense is $1,000 for say marketing or administrative. You can break it out between the 3 properties, but as detailed as possible is normally the best answer. You brought up a good question. So with Airbnb, the way they do their tax remittance now is there's one account, one taxpayer for each Airbnb account. So be very careful if you're also say hosting for somebody else, because you're going to get that W-9 or that 1099 form for that other person's income. Because let's say I have my own Airbnb account, I have my short-term rental, and I also manage somebody else's within that same Airbnb account. I'm going to get a tax statement for that some amount. And a lot of people are realizing this when it's too late, after Airbnb's already sent them the form for that.
All right, so I got a question for you, because we all just had to update our W-9s and everything by like December 2nd or 3rd or whatever it was in Airbnb. Yep. I made sure in my portfolio, mine's in there, but I also have mine added into the accounts that I co-host for. Should I not have my W-9 into the accounts that I co-host for?
Co-host, or you mean you manage yourself? You manage the property for them?
I co-host for them.
Yeah. Okay.
I don't own the listing. So basically what it is for a lot, and there's a lot of co-hosting to where, in my case, my client owns the listing, their W-9's in there as well. And they get, they're taking 80% distribution from Airbnb. I'm taking 20% distribution from Airbnb.
Yeah. If it's set up that way, then that's proper. You don't have anything to worry about then. But okay. It's when people don't have that sort of meshed out, right? Where then they start receiving income for a property that's not theirs, right?
Absolutely. Awesome. Good stuff. First question that's come in here. This is from Jamie Tillery. We're in the process of closing on our first STR. Closing date is January 17th. For tax purposes, do we need to wait until after closing to start making purchases for the property updates that we want to make?
Yeah, good question. I think we had this on a few calls ago, but basically all the costs incurred to get that property rent ready, we'll call it rent ready, those get capitalized and depreciated over the useful life of the property. So typically for short-term rentals, it's going to be 39 years. So in layman's terms, any expense that you have before the property goes into service, you're getting less of a tax benefit than if you were to have that same expense after the property is already placed into service. So then there's this little game of, okay, well, how much can I actually renovate on the property before I make it rent ready, just to get it up to snuff in order to rent it out? And then how much of it can I do after it's already placed into service, maybe between guest stays and whatnot. So that way I can actually qualify to expense those purchases. And the best way to explain this is almost like the Burr method. If you're familiar with the Burr method, and instead of buy, rehabbing, rent, refinance, and repeat, I tell people to add another step. I say to buy, rehab, make it available for rent, then rent it out, then refinance. Because if I have 30K of rehab costs and I do all those before I place a property in service, those all get capitalized and added to the depreciable basis. But let's say the property only really needed 15 in order to get it going, and the other 15 were more cosmetic issues. I can, as long as I do those 15 after I place the property into service, then those can qualify to be immediately expensed rather than depreciated.
So how do we do that, Ryan? So I'm in the middle of renovating 2 properties right now. One's in Fort Morgan, Alabama. I bought it December 10th. It's not in service yet. I've got another 3 to 5 weeks before it's completed. Since I technically can't rent that, are you saying just create the Airbnb, take it live, and then block out my dates so that way it's available? Or do I actually need to have somebody book and stay there before I start renovation? Kind of what qualifies?
Yeah, so rent ready actually means different things in, I would say, each state. So normally if you need a permit to occupy, some localities require you to have a permit or business license. That's essential to be considered a rent ready. You'd absolutely would need something like that. Or for example, just enough expenses to kind of get the property going, right? You can't have it stripped with no electricity or no water and say, oh, it's placed into service and now I can deduct all those costs. A key thing for Airbnb and Vrbo, though, is that the calendar has to be open, right? You can't consider your property placed into service, but your calendar is booked out or it's blocked off, right?
Interesting. My mind's just spinning about kind of exactly how that would work.
Like I wouldn't be able to, like, let's say I bought a short-term rental right now and I'm planning on doing some renovation costs between now and the end of the month. I cannot block my calendar. I cannot say my property's in service, but have my calendar blocked off the entire month.
Right.
Yeah.
Gotcha. Okay, cool. Let's see. We've got a question here. To clarify, if I buy a property, do a cost seg, and then 1031 it a year or 2 later, I'll have to pay back the profits from the cost seg?
No. Normally the 1031 will eliminate your ability to pay. You won't have to pay capital gains tax or depreciation recapture tax, as long as you take all the proceeds and invest it in a new property. If you ever hold on to the cash, that's when it becomes taxable. So think of it like a hot potato. If you ever actually pick up the potato, as in the cash from the property, you're going to get taxed on it. That's kind of how I explain it.
That's something that a lot of people need to take into consideration. I'm just going to use Ryan and myself. How old are you, Ryan?
23.
23. I'm 48. That's a quarter of a century older than Ryan. I'm much closer to death than Ryan is. So my 1031 strategy at my age of 48 versus Ryan's strategy of 1030. I don't even think Ryan should even think about a 1031. He's way too young to do a 1031, right? That's just my investing strategy, not tax advice. But if Ryan did one now and then $100,000 into another property, and 3 years later he sold it, made another $100,000. He's got $200,000 in taxable income, and that third property appreciates by 200. And then he decides to sell it because he needs the cash, and he's only like 29 years old or 30 years old. He's paying on tax on $600,000 because you're going all that back tax to the first 1031, correct?
Yeah, right, exactly. And so for me, my strategy is to never sell, quite frankly. I'm always just going to look to borrow against the appreciated value of the asset and take that cash and buy property. And that's kind of what we were talking about at the mastermind, as well as at the group in Nashville. You know, like I said, as long as you never actually sell the property, you're not going to be faced with a tax burden.
That's a great strategy. Ryan, profit. I love the way you're thinking, because that's what was going through my mind while I paused there for a second of what Ryan, when he said you got to put the property into service.
Yeah.
You know what? So if you have a $300 a night ADR, just price it at $5,000 and nobody's going to book it.
Yeah. So the problem is Airbnb and Vrbo really just came on the scene recently, 2015, 2016. And the IRS, the tax law moves very, very slowly. So these rules haven't really been fermented, or the IRS hasn't even had time to breathe. But personally, I wouldn't consider that property placed into service because it's not at I would say a free market rate. unless you had some knowledge to say and back up to say why your rate is that high. I wouldn't consider that placed into service. To me, that just seems like you're circumnavigating the rule of how a property is placed into service. I wouldn't let that fly at my firm. I would say that. How about that?
Gotcha.
Yeah.
Are there any resources for us for those categories in QuickBooks specifically for real estate investors? For example, furniture and STRs, expense or asset. So I'm going to answer this question for Ryan. Ryan, I would highly recommend as a friend that you put that checklist together and turn it into a lead magnet. Literally a free document that everybody can get, but in exchange they're giving you their email address. If I was you, that's what as your marketing mentor, that's what I'm going to tell you to do.
Can you pop up the question again?
See, he wasn't paying attention. Are there any resources for us for those categories in QuickBooks, specifically for real estate investors, for example? So what I think is she's looking for like the tags, the categories, and everything. Yeah. I think you should put that together in a nice little PDF and distribute that and just have people give you their email address to be able to get access to it. I want to move on to, this is Holly Phillips. Pretty unique question, but I think there's a lot of people that are now doing multiple businesses within short-term rentals. I see this on horse farms. Holly had it, I think she's from here actually. She had a wedding venue. We just started with our first STR, which was a previous home of ours. It's on the same property as our wedding venue. Our accountant told us to run that under a separate LLC. Would it benefit us more to keep it under our venue LLC or a separate one for tax purposes?
The wedding venue, yeah. So I think the presumption is that the STR is a passive rental activity and the wedding venue is actually a business activity. That's going to be more of a separation of liability rather than a tax purpose, but it won't change the tax scenario whether or not you keep it under the same LLC or you break it out into two LLCs. But from a liability perspective, you may want to consider separating them because there are two different activities. So if something were to say go wrong in the wedding venue, they would try to come after your short-term rental activity, or vice versa. Like let's say something were to go wrong in your short-term rental, they would have to try to come after your wedding venue activity. So it's probably best to separate those two activities under two different LLCs, but it's not a tax answer. It's more of a legal answer.
Great answer. So I saw on Facebook earlier this morning, not in my group, in another group, somebody recommended that the only way that you can get your income classified as passive is to where you have your LLC and you have your STR in one LLC, and then you create another entity to run that revenue through a property management company. And he's strictly not talking about liability protection. He's talking about tax purposes. Can you elaborate on that type of a structure at all? And is that type of a structure required to essentially have two entities to eliminate tax as passive income?
Well, passive income is going to be passive. So if I just have a rental property in a Schedule E, it's passive income. So I'm not paying any payroll tax. Payroll tax is the Social Security and Medicare. So if you look at your W-2 pay stub, it'll say Social Security, Medicare. You don't pay that with passive activities. But setting up some sort of structure, all that you're doing is converting income that was passive to now non-passive. So that's generally something I don't recommend people to do unless there's a purpose beyond something greater. So like, let's say you got 3 or 4 properties and you're managing your properties. A lot of people will say, well, I'm going to pay myself out of the property. So for tax benefits, but there are none because you're taking income that was passive and it's not going to get hit with payroll tax, and it's now subject to payroll tax. So you're essentially, by paying yourself out of a business, you're assessing an extra 15% tax on yourself.
Yeah, I think that is very important because I think there's more than a handful of people that are giving that type of advice in our industry. And it's also going to increase your cost with your CPA to file at the end of the year. It's going to increase your
unemployment insurance.
Absolutely. Unemployment insurance, depending on your state, you could have work requirement for workers' comp insurance. You're going to have more. You're going to have more filing costs. You're going to have to pay the annual fee for your sub S, your LLC, whatever it is. I see no compelling rationale of why anybody would want to set up under that structure from a tax purposes standpoint, possibly from a liability standpoint, but not necessarily a tax purpose. Would you agree with that?
Yeah, I think it's a liability and almost like wealth, personal finance. So some people will do it because they're like, hey, if all my income's coming from passive, that means I'm not actually paying into Social Security. So they're not going to expect a check from the government. But if you're listening to this right now and you're a real estate investor, don't even expect a check from the government anyway. Create your own passive income stream. I'll tell you that right now. But some people will pay themselves out of a rental because then they'll turn around and want to be able to contribute to a retirement account. See, if all you have is passive income and not earned income, you can't contribute to retirement accounts. So if all my income is from rentals, I can't contribute to a retirement account. But then it's like the chicken and the egg problem, right? If I have enough cash flow from rentals, I mean, I don't care about a retirement account.
Well, I mean, you can do your own. You can do your own SEP, your own 401, whatever you'd want to do, right?
Only with earned income. Right, so that's why some people they might want to pay themselves, but just for that purpose of having.
Hold the phone a second. So you're telling me passive income you cannot invest into a SEP or a Roth, a 401?
It has to be earned. It has to be earned income.
Well, I guess I better keep my earned income then, because I had no idea that was the case.
Mm-hmm. Yeah, 401k. You have to, and that's why some people will want to pay themselves out of the rental, right?
Gotcha. So that strategy becomes really important. Ryan Pace from YouTube. Can we use your tax service for an LTR in Michigan? And soon we'll be purchasing an STR in Tennessee. So you do LTR or just STR?
I do both. I started with LTR and then kind of moved in the short-term rental space just because the numbers were bigger and the cash flow is better. But yeah, two different activities, right? Short-term rental, long-term rental. But for tax purposes, they're a little similar. But yes, we can do both, Michigan and Tennessee. Yeah.
Cool. I think, Jamie, this was your question. Yes, you were the first one that Ryan answered in regards to how you would want to purchase your property.
She can go back and watch it, right?
Yeah, exactly.
Okay.
If you were setting up a new corporate structure for tax purposes, how would you set up yours for Ryan Bakke? And let's say that you're starting with your first STR and you plan to scale to somewhere between 3 to 5. Which is probably a reality for you, right? So Are you doing LLCs? Are you doing the Wyoming thing? Are you doing a sub S corp? Not for what you would recommend for anybody else, but what would Ryan, I called you back, I'm sorry. What would Ryan Bakke do for your own setup from tax purposes, not liability?
For tax purposes, I would have them in separate LLCs, each one. That is, I guess, another liability. But yeah, whether or not they're in separate LLCs or they're not in LLCs at all, they get taxed the same way, right? They're flow through. It's going to hit your Schedule E, and that's where the income tax is going to flush out. But from a liability perspective, yeah, I'm going to set them up in separate LLCs, and that's really just a risk assessment, right? You got to look at what your total net worth is and how much do you have at stake in rental properties compared to what your total net worth is. But then also sometimes people will say, hey, once I get, say, 100,000 equity in each property, that's when I'll move it to an LLC. There's a lot of, I'm just having single member LLCs and they're hitting my personal tax return. That's it. I'm not getting there's no fancy workaround this. Now, if you have partners, then it gets a little bit complicated. You might have to file a partnership tax return. But if I'm just buying properties, they're going to be in their own LLC and they're going to flow right through to my personal.
Awesome. Great advice. I got to give a shout out to Angie Lane. If you guys aren't familiar with Lewis Smith Lake in Alabama, I actually own 2 properties there, soon to be 1. Hopefully put 1 under contract today to sell. But Angie's with Justin Dyer Real Estate down there, and her team. I use Angie's Cindy Myricks, Justin Dyer. They're absolutely amazing. And I shouldn't say this, but Lewis Smith Lake is about I think it's the number 6th best lake from an STR that I've done research on in the entire country. That's why I invest there. But hey, Angie, thanks for joining in. Ryan, do you recommend rolling over a 401k into a Rob structure to actively buy and manage STRs?
Yeah,
I don't know what a Rob structure is, so explain what a Rob structure is if you know what that is.
That's news to me.
Are you Googling it?
Rollover 401k. Rollover for business startups. Yeah, that I didn't know it was called that. I am a big fan of taking retirement account money and investing it into real estate because there's tax deferred or tax free treatment. So if you have money sitting in a Roth account or a traditional account, you can buy real estate actually in your retirement account. And as long as you follow the normal rules of the retirement income has, you're not going to pay taxes as the property is growing in value. I'm a big fan of taking money out of the stock market and Wall Street and investing it in something that people know and love, which is real estate. I mean, I wouldn't tell people to take all their money out of retirement to invest in real estate, but I'm certainly funding my retirement accounts with the anticipation of using the money to buy real estate instead of invested in the stock market.
All right, so I'm being hypothetical here. I have $500,000 in my 401k. I want to take $100,000 out to buy a $500,000 property out of my 401k. How do I do that, and what's my tax burden?
So you want to take it out to buy a short-term rental, or do you want to convert it into or roll it to a self-directed IRA to buy real estate?
How do I not pay taxes on it? You tell me.
So you could either just keep it in the same account, don't pull it out, and just simply convert it to a self-directed IRA, and there'd be no taxes there. But the real estate kind of grows in the retirement account, and it doesn't really mess with anything else. It files its own tax return, and your retirement account files its own tax return, and it's kind of separate from your personal until you turn 59 and a half, and that's when you can actually pull that money out, right? Or I mean, some of the strategies that we're doing this year is people are cashing out the 401k. They're going to pay the 10% penalty with the idea that, hey, now they have to pay income tax on the distribution. But if they're doing cost segregation and the strategy, they're able to offset that distribution pull with the depreciation.
Right. What's the maximum annual contribution to a self-directed IRA?
An IRA account is only $6,000. An IRA account, but you can do so like a solo 401k, which is what I have. I think it's almost $60,000 a year now. I could put into that thing.
Okay. So let's say I put $60,000 in last year and I already put $60,000 in this year. I got $120,000, right? So then I can use that 120,000 in a self-directed to where I can go and I can use that to buy a property.
Yep. Yeah.
Then what happens if I sell that property and that 120 turns into 300 2 years down the road? Does that just stay within that 401k?
Yep. It sits in the 401k. There's not going to be any tax unless you take out what's called UBIT or UDFI, which is like, let's say you take your 100k and you take 300k of non-recourse debt. Let's say you borrowed, then you might have a tax there. But as long as you never touch the hot potato, you're not going to get taxed, right?
So it's very similar. You treat it almost like a 1031, right? You're not physically touching those funds and you're not using it for anything else.
Yeah, it's more of like an equity appreciation play than it obviously is, because you'll never be able to touch the cash. You'll never be able to really touch that money until you're 59 and a half. But it's very great. I mean, I've seen people turn 300k into 5 million within 15 years. I've heard of people being able to do that, and because they're able to take their retirement money and invest in real estate rather than the stock market.
Yeah, no, I agree. I mean, you were at the boot camp, and I showed everybody how I've taken 172,000 and turned it into 8.8 million in assets, and that doesn't even include the cash flow that I've generated out of it. It doesn't include the buildup of my 1031 component on the sales that I've done. I agree with that 100%.
Brings up a point, because when I was in college, they were teaching us to get out of debt and to get into retirement accounts. Like, get out of debt, start investing in retirement accounts. And then it's like when you get in the real world, you understand that all the rich and wealthy people, they're getting into debt and they're getting out of retirement accounts.
Except for Dave Ramsey followers.
Yeah.
Yes. And there's no right way or wrong way, folks. I mean, look, Dave Ramsey lives like 2 miles from me. I know Dave and I like him, but I'm not a guy that's looking to build wealth out of cash. It's way too difficult. So
yeah.
On that $8.8 million valuation of my real estate portfolio, I've got $4 million in debt. And, I'm getting ready to take on another $2 million in debt probably in the next 60 days. But hopefully, if that appreciates, Ryan, at just 5% a year, not even the mega appreciation
half a
we've
million
had over the last 2 years, and this property's on the book should do about $400,000 a year in revenue. That's a lot better than getting 5 to 6% out of an ETF, right?
Yeah, and that's a good point you bring up, because we like to use the cash on cash metric to assess return, and everybody now just know that cash on cash is going to be different based on the investor. You and I could come to a deal. You might have 20% cash or 20% down. I might have 10%. So our cash on cash is going to be a little bit different. So there's different metrics that people can use to. I mean, do you use cash on cash primarily? It seems like to be there.
I use cash on cash a lot because I'm primarily a 20% down guy. I've done one deal at 15%. Actually, I've done two deals at 15%. I'm not a 10% guy because I mean, I've been through three downturns now. And if I got to liquidate something, I want to have some equity inside of it. That's kind of my security blanket. So I'm not a 90% LTV guy. So I do use cash on cash, and I don't factor in appreciation into my investments. That's kind of the icing on the cake when I get ready to sell.
You don't factor in appreciation at all.
I mean, I look at appreciating markets, no question.
Yeah, right.
But I do not factor that into my pro forma when I'm looking to buy a property, because when I go and I'm doing a new startup, and I've done 31 startups in my life, I'm looking at building a cash flow basis business. I'm not going in and looking to take on, literally a Series A, a Series B, go public, or, do an exit on a SaaS, type of a company. I'm a small mom and pop type of builder, so I'm looking strictly at cash flow. And then if I can get a valuation because I built a profitable, scalable, repeatable business, then I'll look at my multiple on the exit. Does that make sense?
Makes sense,
so
yeah.
I think there's a lot of markets that are appreciating extremely fast historically, even outside of the last 2 years. And people are looking at that. For me, that's more of an LTR strategy than it is an STR. STR is all about getting the 7 to 9 times LTR on the cash flow, in my opinion. And then take like what Ryan's doing. He's in his early 20s. He's a buy and hold till death type of guy. Imagine if he buys 10 properties over the course of the next 20 years. That's one property every other year. What type of equity he's going to have in those properties when he's ready to retire in somewhere between 20 to 40 years. It'll be massive.
Yeah, right.
I love it. All right, we're over our time. Are you cool for maybe one or two more questions?
Yeah, let's do it.
All right. REIT hours. Explain why REIT hours help with taxes. Is it always worth it, or are some incomes so low it's not worth the work of recording?
I think I think they were referring to real estate professional hours.
Agreed.
Yeah. I would say for taxpayers who are at lower tax brackets, the deferring the tax to later might actually come back to bite them, right? Because if I'm in a 10 or 12% bracket this year and I defer that tax into a later year, and then now I have more equity, more appreciation, more cash flow, I might be hitting myself, or might be shooting myself in the foot, because now when I actually go to liquidate those assets, I'm going to be taxed at a higher rate. I tell clients, if they're owning short-term rentals, especially short-term rentals, maybe not long-term rentals, but short-term rentals, they should be tracking their hours, because it gives us options. So when we talk about like those grouping tests, we talked about the 500-hour test, and that's 500 hours across all properties. And so if I have properties that are not managed by me, but by somebody else, I have no shot at claiming that if I don't have any other properties. But you see people that say have 2 or 3, 4 properties, they manage 2 or 3 of them. The other one's managed by a property manager. They can actually group in that 4th property with the other ones. So as long as they meet their 500 hours. So that's where tracking the hours comes in to play. Even if you don't think that you may not qualify for it, I still tell people to try to do it anyway, because it gives us options.
Awesome. Let's do one more question. This is from Minda. You can't self-manage that property that you purchase in your self-directed 401k, right?
Yes, that's correct. Yeah. So there's very strict rules on who's able to actually step foot in that property and manage it themselves. And typically you have to hire somebody to do the day-to-day management of the property. Is one of the cons, because you're not allowed to do what's called self-dealing with inside of that account. And so one of the contingencies is that you're not allowed to manage it or really turn a wrench inside of there.
Well,
you can hire somebody.
That's kind of
hire somebody to do it. Yeah.
You're going to give all your profit away to a property manager, so you better think about that before you tap into that self-directed 401k, right?
It's something to consider. Yeah, for sure.
Cool. Awesome. Ryan, thank you very much. Thank you, everybody, for all your great questions. We'll be doing this again for next week, Ryan.
Yep.
Same bat time, same bat channel, right here. All the Build Short-Term Rental Wealth platforms. Thank you guys for your tremendous
help. Thank you, everyone.
Most importantly, don't sit on starting to work on your taxes. Get that shit done as quickly as you can. Ryan is in a million different places, from Twitter, Instagram, Facebook. He's got his own group. Ryan, how do these people get in contact with you?
Yeah, so the Instagram and Twitter is just going to be at Learn Like a CPA. And then we have a Facebook group called Tax Strategies for Real Estate Investors. You can find
definitely should follow Ryan and get in that group as well. Have a great day, everybody. Thanks for joining us on Tax Tuesday. Get cracking on your taxes, folks.